morning, everyone, and welcome to another CBSN Gen Next webinar. Gene is a past columnist for both the New York Times and the Washington Post. Gene now writes regularly for The Hill, the Philadelphia Inquirer, Forbes, Inc. magazine, Entrepreneur magazine, and The Guardian. He has written 5 books on business management, specifically geared towards small and medium-sized companies. His most recent is Want More Cash, 100 plus ideas and strategies for increasing your company's cash flow this year. Nationally, Gene appears regularly on Fox News and MSNBC, as well as the John Batchelor Show and Sirius XM's Wharton Business Channel, where he talks about the financial, economic, and technology issues that affect business leaders today. Gene owns and operates the Marks Group PC, a highly successful 10-person firm that provides technology and consulting services to small and medium-sized businesses. Gene helps business owners, executives, and managers understand the political, economic, and technological trends that will affect their companies, and most importantly, the actions they can take to continue to grow and profit. Just a couple of housekeeping notes. This webinar is being recorded and will be posted on our website by this Monday. And don't forget to type your questions in the chat room and in the Q&A sections during this presentation. We will have a Q&A session at the end of Gene's presentation. So please welcome Gene Marks.
Thank you, Angelo. I appreciate you having me on. And Angelo, just making sure you can see my screen and my PowerPoint.
You got it, yep.
All right, very cool. So I guess the ball's on me now. Guys, thank you very much for joining. And if you're watching this later in the game, which is what I tend to do rather than live, that's also fine as well. I know that you won't be able to participate in the Q&A if you're looking at the archive version, but I do have my email address at the very end of this presentation. So if you are watching this after the fact and it's not live and you've got questions that you'd like to email me directly, that's completely fine. I welcome them, so feel free to do that. This presentation, which you know, we're going to go through a lot of stuff here, but I want to be clear. This is not designed to make you a tax expert. What this is really designed to do is to make you aware of all of the tax benefits, the incentives, the deductions, the credits, the strategies that you should have as a business owner, so that you can actually sit down and talk about them with your accountant, because that's the idea here. You know, it is no one's saying that you have to be a tax expert or professional, but listen, it's your business, and in the end, you know, when you add up all the taxes that you pay, local, you know, state, sales tax, federal tax, whatever. It's for some of my clients, it's anywhere from 20 to 30% of their income. It is a giant number, and it needs taking a lot of attention. Now, the other thing that you're doing very right, for all of you guys that are here joining me live, is that you're watching this, and I'm doing this in March. And that's a good thing, because I'm not going to talk to you about how to save your taxes from 2020, because that year is over. What I'm going to talk to you about is all the things that you should be doing and thinking about and strategizing and then taking actions for now and throughout 2021 and then beyond, so that you can actually have the time to fully take advantage of some of these things. So those are the kind of things that we're going to really be focusing on. And one final thing before I jump into it is that there are a lot of things, tax incentives that of course will save you money, but I will be talking about some tax moves that you could be making that will help you attract employees to your business, because the government is giving us all, as business owners, a lot of tax incentives that we can use to provide better benefits to our employees. And by doing so, we can be more competitive with other people because we can offer these benefits and get tax advantages for doing it, so it costs us less to do. And the fact of the matter is, maybe you guys being in the auto industry, I am sure there are some of you that are having a hard time already finding employees. Even with unemployment the way it is going to heat up a lot over the next few months and in the second half of 2021 as we recover from the pandemic, and having the best benefits, the best compensation packages, getting the most help to do that will help you attract the best employees from your business, okay? So let's go. Let's move into it. Again, email me. First of all, put in any questions in the Q&A pane. Email me afterwards if you'd like a full copy of this PDF that I can send to you as well, or if you've got any specific questions. Now, the first area that I want to talk about has to do with all of the tax opportunities related to COVID. This stuff is up to date to the minute today. And today, as I am talking to you, it is the middle of March. The new stimulus bill has passed the House. For those of you watching after the fact, it hasn't been signed yet by the president, but it's about to be. So everything I'm going to talk to you about is up to the minute stuff that includes the third, this last stimulus bill, and it's stuff that you should really know to take advantage of. So the first thing that I want to talk to you about is the employee retention tax credit. If you are eligible for this tax credit, it could save you an enormous amount of money this year. Now, how are you eligible for this tax credit? It's one of three things. In any quarter of 2020 or 2021, if you were either shut down by the government, fully shut down, if you were partially shut down, in other words, parts of your business couldn't operate because of the restrictions that were involved, and that includes if you had to send people home to work and you had to shut down your offices, you would be eligible for this. Or number three, if in any quarter, let's talk about 2021, if this year you have in any quarter revenues that are 20% less than the same quarter in 2019, not 2020, but 2019, you're going to compare 2021 to 2019, then you're eligible for this tax credit as well. So it's a 20% decline in revenues. There's the similar rule for 2020, but you had to have a 50% decline in revenues quarter to quarter, okay? So let's say you're eligible. Let's say you've been partially shut down, fully shut down, and you've lost 20% of your revenues in any quarter this year versus 2019, okay? What do you get? Well, you get up to a $7,000 per employee per quarter tax credit. It's 70% of their salaries up to $10,000. So it's up to $7,000 per employee. You calculate it on your quarterly 941 tax return, and you apply the credit against the payroll taxes that you owe, the FICA and now Medicare taxes that you owe the government for your payroll. If the credit is bigger than the payroll taxes that you owe, you can get the cash back from the government. So again, this is a big credit. You can take it quarter to quarter this year. You do it on your quarterly 941s. You apply it against the payroll taxes. And if the credit is bigger than what the taxes are that you owe, you'll get the cash back. And by the way, if you're participating in the Paycheck Protection Program, either in 2020 or 2021, because you can go back and claim this credit now for 2020. If you're participating in the PPP program, you can still do this. It's just that you can't use the same wages that you're using for forgiveness of the loans, and you're also going to use them as well to calculate this credit. In other words, no double dipping. But you can still participate in the PPP program and also be eligible for the employee retention tax credit. So let's recap all of this. It was extended through the end of this year with this third stimulus. So it's each quarter of 2021. You either need to be partially or fully shut down because of COVID. And again, partially means everybody had to go home from the offices. Your offices were shut down. That's a partial shutdown. Or you had a 20% decline in quarterly revenues compared to 2019. That's 2021 quarterly revenues. If you want to go back and claim the credit for 2020, it is a 50% decline compared to 2019, just so you know. The credit is $7,000 per employee per quarter, up to that amount. It's 70% of their wages, up to $10,000. You take it against the FICA. You'll also be taking it against Medicare taxes after June 30th. You can go back and amend do it for 2020, and you can also do it even if you're participating in the Paycheck Protection Program. So big deal, big credit, big money that could be available to you. That's the first thing. Next, related to COVID, is the Families First Coronavirus Response Act. This act actually dates back before the CARES Act. It was like the first thing that the government did back in like March of 2020. And the act told employers, listen, if any of your employees can't come to work because they're sick from COVID, or their family members are sick from COVID, or they have to watch after their kids while they're home, getting, because of school homeschooling, for virtual schooling, you have to pay your employees for up to 12 weeks while they're out. And there's a certain rate that you have to pay them. That was required. However, if you're doing that, you can take a tax credit again against your payroll taxes and get the money back that you're paying your employees. So it's a requirement that you pay, but you get this refundable tax credit. Well, 2020 ended. You are no longer required to do this. You're no longer required to pay for your employees if they're out taking care of their families or if they have COVID. However, if you do decide to still pay them through September 30th, good for you. The government will still give you that tax credit. It will still be available. And by the way, if your employees have to miss work to get a vaccination, and even if they have a reaction to the vaccination, so they have to miss a couple of days, for example, you pay them while they're out under this bill, under this act, you can get a tax credit for what you paid them. Again, you take it on the 941 tax return. So this is not required past 1/1/21 this year. It provides compensation to all the employees that are affected by COVID, and the tax credit is available through September 30th of 2021. That's this year. So that's another tax credit that you can be taking in addition to the employee retention tax credit. So that's the second thing we want to talk about. Now, we're still in COVID. This is a new thing. It's the Cobra Credit. And it works like this. If an employee gets laid off, they can still get health insurance through Cobra. They have to pay you for the health insurance, okay? Well, if your employee is doing that, they can get a credit against their taxes for whatever they're paying for this Cobra coverage. If you decide to keep the employee on the insurance, even though they've been laid off, under Cobra, you still pay the health insurance. If you choose to do that, you can get a credit as well. So again, this was included in the March 2021 stimulus. Again, it's a tax credit. If you pay the Cobra insurance for your employees, you can get a tax credit, and that's calculated on your 941 returns again, and it's yet another credit that is due to you. So that's the third thing that's related to the COVID bill. Let me tell you about the fourth thing under the COVID bill, and this is a big thing. It's called the Work Opportunity Tax Credit. This credit has actually been around for a number of years. It was just extended through 2025 because of the stimulus, and this is a big deal. You don't even have to qualify for this one. Here's how it works. If you hire anybody this year that's either a veteran, comes off of welfare, or, listen, has been more than 6 months unemployed, if you hire that person, you can get a credit against your taxes for anywhere from $1,200 to $9,600, a credit against the income taxes that your company owes. Even if you're a partnership or an S corporation, you still get that credit. So hear me out. Say this year you hire 5 people during the year, and let's say all 5 of them have been unemployed for more than 6 months, you would be able to get a work opportunity tax credit for each of those employees. So keep that in mind. Some of my clients, we talk about benefits, they're competing for people as they're coming back. Well, if you work with your accountant and figure out what the tax credit could be, maybe you make it a signing bonus. Maybe you pay that employee something extra to come on and join your company. You're going to get the money back as a credit on your taxes, so it doesn't cost you anything, but that little sweetener might be the difference between that great employee coming to work for you or going to work for the guy down the street. So it is a great, great incentive for you to hire people. It's been extended through 2025. Again, it applies to hiring veterans, welfare recipients, and again, the long-term unemployed, and the credit amount $1,200 to $9,600 per employee is what that credit is. It depends on the calculation that you do. So make that part of your hiring plans this year. I'm not done. We're still on all of the stimulus stuff, okay? The next has to do with charitable deductions. Now, personally, if you donate to a charity in 2021, individually, you can get a $300 deduction above the standard deduction, above it. If you file jointly, you can get a $600 deduction. Your company, if you want to be charitable this year, only this year, you can deduct up to 25% of your taxable income in the form of a charitable deduction. If you make that to a charity, you can take that. It's normally 10%, but this year only, you can take a deduction of up to 25% of your taxable income for any donations that you're making to a charity. And bear in mind, if you're working for a charity or you're on a board of a charity, this is an amazing way to get donations from both private individuals and from companies because of these amazing tax incentives that are available. 1 year only, it is a charity. So again, this was extended through the end of 2021. For individuals, $600 jointly, $300 individually. The deduction is above the standard deduction. And for corporations, you get up to 25% of your taxable income. You can take as a deduction for any charitable contributions that you make. Now, the last thing that I'd like to talk about related to COVID is losses. Now, I don't know if you guys lost money or not, but I want you to pay attention to this because this is a one-time only deal, only because of the stimulus plans, the 3 big stimulus plans, the CARES Act, the one in December, and then this American Rescue one that just happened just in March. And here's what it is. If your company lost money in 2020 or 2019 or 2018, if you lost money in any one of those 3 years, you have the chance, one time only, to carry that loss back 5 years. You're normally not allowed to do that anymore, but one time only you're allowed to do that. If you carry the loss back 5 years, if you made any money during those 5 years and you paid taxes in, you're obviously going to be you'll be due taxes back because you're carrying back the losses. And that's cash that the government will give back to you. So if you lost money in 2020, or 2019 or 2018, carry that loss. You got to amend your returns, carry the loss back, claim back the taxes that you had paid in during those years. The government will give you, it takes about 6 weeks from when you file an amended return. It is something that's really important for you to do and consider. So it's one time only for 2020 through 2019 and 2018. To carry back your losses for 5 years. Remember that you do that. And again, you do want to file as soon as you can, only because it does take 6 weeks at least, and the IRS is backed up, as you can imagine, to get those refund checks made, okay? So let's talk about what we have learned so far, okay? Lots of opportunities under COVID to save you money on your taxes. There's the employee retention tax credit. You can defer your payroll taxes and the FFCRA, the Families First Coronavirus Relief Act extension. There's the work opportunity tax credit. There's the Cobra benefit as well, which I actually don't have on this list. There's charitable contribution deductions are bigger, and you can now carry back your losses as well. Those are all things available to you under the 3 stimulus plans, and that is current as of today. And I'm talking to you, it's the middle of March. So this is all current stuff. Talk to your accountant now and make some plans. Okay. Let's talk about some other tax strategies to save you money this year and the years going forward. Now, the first one that I'd like to kind of mention, just have to do some thoughts, just some thoughts I want to share with you about your compensation. Okay. Now, this is stuff I get asked about a lot, so I just want to make this stuff clear, just in case there's no debate about it. The first has to do with about paying yourself, and I want to make sure that you know the rule of thumb here. Okay. If your business is a C corporation, so you file an 1120, a C return, a C corporation return, you want to pay yourself a reasonable salary, okay, and you'll take the deduction for it. So, but you want to pay yourself as high a salary as possible, but as reasonable as possible, obviously. So get some data as to what typical salaries are in your region. Pay that as high as possible. You'll take the tax deduction and that's it. Because if you take any other withdrawals from your business, it's going to be considered to be dividends, and you're going to get taxed on those as well. So C corporation owners benefit by the higher salaries that they have. If you have a pass-through corporation like an S Corp or a partnership, the opposite kind of applies. You want to pay yourself a reasonable salary as well. Again, you want to get data for your area, but you want to pay on the lower end of that reasonable salary. That way you minimize the payroll taxes or estate taxes that you might pay on your compensation. And then if you need any more money out of the business, you take that money out in the form of draws, okay? Because remember, in S Corp, whatever is left, goes and flows through to your individual return and gets taxed at that level. So you pay yourself the lowest level salary, you'll take the deduction for it, but you'll minimize your payroll taxes, and then you'll pay your income taxes at the end on your personal return. You'll wind up saving money that way by just paying the lowest salary that you can that's reasonable within in your area. So I get that question a lot, and I want to make sure that you're aware of that. Hiring your kids is another big deal that a lot of people do. Remember, guys, your standard deduction it's $12,100 a year individually. So when your kids file a tax return, they get that standard deduction. Well, listen, you can pay your kids $12,100 a year, and then when they file their tax returns, they'll take the full standard deduction against it. They won't pay any taxes against it, and you can get a deduction for that in your business. Now, of course, they must be a reasonable age, and they must be of an age where they're filing their own tax returns. But just be aware, it is a way that you can not only take that tax deduction, pass through income down to them for reasonable work that they're doing, give them some work incentive. Hopefully they're saving it. I mean, take the paycheck out of their hands before they spend it on like a Xbox or something, put it into savings, but at least you can get some incentive for doing that. By the way, there's no family relation connection here. I mean, you don't have to, it doesn't have to be your kids, it can be your neighbor's kids. But just so you know, that's why you can keep high school kids, middle school kids involved and give them some learning experience, and both people benefit. They don't pay taxes, you get a deduction for it. And then there's also the home office deduction. Now, the home office deduction was kind of taken away in 2017 for home office workers. But if you're self-employed and you're watching this, be aware that there is certainly a home office deduction available for you. I mean, your home office has to be a principal place of business. It must be exclusive and regular. You can't just have a desk in your bedroom. It really has to be, like separately laid out as a home office itself. If you don't use the deduction, you can carry it forward. And there's really two ways that you calculate this home office deduction. You do this on your Schedule C return, basically. It is, you can use actual expenses. So you take like a percentage of the expenses that you're paying, which is good if your home office is more than 300 square foot, or if you have high utility or other costs or more admin. It requires some more admin work, but you might maximize your deduction that way. Otherwise, from the home office standpoint, you can just take a easy way out. The IRS has a simplified method. It's $5 times 300 square feet a maximum, or a maximum $1,500 home office deduction for working in your office. So again, you have those available to you for your compensation. So again, if you own a pass-through, pay yourself less. If you own a C Corp, pay yourself more. Hire your kids and maximize that home office deduction when it comes to if you are a self-employed individual. Okay. Now let's talk about your property, and let us discuss some of the ways that you can be saving money on your property as well. And again, these are all readily available for you. These are the kinds of things that like my smartest clients are doing. So these are the things that I'm hoping that you will take under serious consideration. Let me grab a quick drink of water. Okay. The first move that you want to make to save money in your business is this. Do a full balance sheet review. You've got receivables and you've got inventory, right? And I can tell you, if you're like a lot of my clients and me as well, we're business owners. We tend to be overly optimistic sometimes. There is probably a good chance that you've got on your receivables aging some older receivables, like a lot older receivables. And I'm sure you've had plenty of promises and you have plenty of reason to believe that they will be collected. But in all honesty, if they're more than, say, 120 days, that's the rule of thumb we tell our clients, write them off. Get them off your books entirely, reverse the sale. If you want to track them on a separate spreadsheet, and if the money comes raining down from heaven, that's great news. But for the most part, get it off your books, because you can't take a deduction for a bad debt unless you write it off your books. So write it off, track it separately. Number 2 is inventory. Now again, if I walk around your place, you've got a lot of spare parts. You've got a lot of parts that you're using for service and for the repair work and the work that you're doing. I am going to bet that you've got a lot of inventory laying around that hasn't been used in years, and you know it. I'm going to bet that you probably bought some inventory from somebody going out of business or at an auction or somebody nearby, and you think you got a great deal, and that same piece of inventory has been sitting there for like 10 years. I'm going to bet on that. It's probably the case. Well, guess what? If you're carrying that inventory on your books, write it off. And you can only write it off by getting it out, by disposing it out of your place. Not only does that free up room and reduce your overhead, but you could take a tax deduction for it. So my advice to you is, by the fall, maybe in October or November, do a thorough review of your receivables and your inventory. Write off all the bad stuff. Track it separately on a spreadsheet if you want to, but get it off your books. Take the deduction for it, reverse it, so that way you've got a real clean balance sheet, and that way you will maximize your tax savings. So that's number 1. Number 2, let's talk about capital equipment. The Section 179 deduction is a huge benefit for businesses regardless of your size. You can take a deduction for up to about, I think it's $1,050,000 this year. So let's say around $1 million this year. You can take a deduction for any capital equipment that you buy. It's furniture, it could be technology, it could be, a piece of, machinery, it could be a forklift, all of that. If it's a capital equipment, you don't have to depreciate it over time. You can take the full deduction right away and write it off this year. It can be used equipment as well. It can't be inherited, of course, but here's the thing. If you buy this capital equipment, the rule is it just needs to be placed into service to get the deduction, which means that you can buy a nice piece of equipment and get it financed. And if you get it financed, and interest rates are historically low, you can put this equipment into production. You still get the full deduction for it that year, even though you've financed the entire thing. So consider that going forward of any capital equipment needs that you have. And because of COVID, a lot of companies, they're either going out of business or they're cutting back or they're cash strapped. There's a lot of equipment deals that are out there right now. And there's a great opportunity for you to snap it up and then get a big tax deduction by buying capital equipment. The next thing has to do with disabled access. So if you have less than 30 employees in your business and you build an area for disabled access, for people, disabled people can get access to your business, you can get a $5,000 credit this year just for doing that. So it's a big credit. You have to have revenues up to $1 million or no more than 30 employees, but that credit for disabled access is there and available for you. Okay. So recapping, we talked about all these COVID opportunities, and in addition, we talked about compensation. Pay yourself less, again, if you are an S corporation and take a distribution. Hire your kids, pay them up to $12,000, and they'll get the deduction, and you'll get the deduction. They won't have to pay taxes on it. Take a home office deduction as well. And then when it comes to your property, just clean up your balance sheet by the end of the year. Get rid of your AR, get rid of old inventory. Invest in capital equipment, get the full deduction for that right away. And if you are less than 30 employees and less than $1 million in revenues, you can get credit for disabled access as well. Okay, I got lots and lots more. Let's talk about your employees. Now, I mentioned at the beginning of this presentation that the government is giving you the ability, some tax incentives that will make it easier for you to pay your employees and offer better benefits to your employees. And the things that I'm going to recommend to you here, you should be considering these benefits because you get tax incentives to do it and advertising this among both your current and your future employees. So the first has to do with this. There's dependent care. So you can get up to a $5,000 deduction per employee if you help them out with dependent care. And that's dependent care for their kids or dependent care for people that they're taking care of, like their parents. So if they have those expenses and they need to pay for daycare or childcare or somebody to be in the home to look after people that are considered to be dependents of theirs, you can give them the money, you can take the deduction, and they do not get taxed for it. This is per employee up to $5,000. If you are so inclined to build out a dependent care facility, or if you want to share that with some other businesses and together build out a facility, you can get a tax credit of up to 25% of the cost of doing that. The maximum credit is $150,000. You can share that among other people. And that's like building the facility and then paying to operating it or paying an outside service. All of those things are really, really important for your employees. And you can set up a flexible spending accounts for dependent care as well, where your employees can contribute up to $5,000 a year out of their salaries, and then they can take, it's pre-tax, and then they can take the money out and use it for dependent care expenses, which means that they can save, depending on what their tax rate is, anywhere from probably 15 to 25% of what their dependent care expenses are. So just the top one and the bottom one, it's a minimal cost to you. It is a great benefit that you can provide. It gives you the chance to help out your employees with dependent care, a big issue among many employees, and also gives the employees the chance to put money away on their own and save some money. It is a great, great incentive to attract employees to your business, particularly younger employees that have kids or thinking of having kids. They know that you are that much of a work-friendly environment. Now, there's more. In addition to all the dependent care, there's education. So when I talk about education, this can be any type of education. It can be related to the job, or it doesn't have to be related to the job. For each of your employees, if you want to pay for their educational costs each year, you can take a deduction of up to $5,250 per employee, and they do not get taxed on it. So, okay, I'm not saying it has to be a $5,000 benefit, but maybe you say to your employees, hey, you come and work for us, and we'll give you a $500, we'll reimburse you for any class you want to. You want to learn how to fly an airplane or do cooking or learn, wellness or Pilates. One of the benefits of working for us, we'll give you $500. You could take a full deduction for that, up to $5,250 per employee, and the employee itself gets doesn't have to pay for any, for that money either. They don't have to pay taxes on that. Remember, if you're going to do this, you really have to make it equitable among all of your employees. It can't just be to like you and your spouse or to your kids that are working in the business. Besides that, you might want to consider revisiting your paid time off plans. Now, because so many people have been working from home, it's now called work from anywhere. A lot of people are considered to be, they're mobile. They want more PTO. They want at least more flexibility and independence. So a lot of my clients are going back and revisiting their paid time off plans for this year. The government is giving you help with this. If people need to take time off under the Family and Medical Leave Act because they are taking care of a sick person or taking care of their own, and you're not paying them to do that, but you're holding their job, the government says, hey, listen, if you do pay them 50% of their salary, you can get a tax credit of anywhere from 12.5% to 25% of what you're paying them, depending on how much you're paying them. So the Family and Medical Leave Act has been expanded. The Tax Act, this was from 2017 Tax Act, gives you the ability to do just that. And finally, there's adoption. So you can deduct, if you want to help out your employees with adoption, you can deduct $13,570 a year per employee to help them with their adoption expenses. Now, again, I am not saying that you want to offer a benefit of $13,000 a year per employee, but maybe it's a couple $1,000 a year. I mean, first of all, you know that a low percentage of your employees are going to be going for adoption anyway, and it's a nice benefit to offer. And if you offer it, they don't get taxed on it, and you get a deduction for doing that as well, which is a really great incentive for your employees. So we talked about education, we talked about paid time off, we talked about adoption, we talked about dependent care. These are all incentives that the IRS is giving us to help better pay our employees. Let's talk a little bit about healthcare and retirement. So first of all, when it comes to healthcare, HSA plans are the thing. Everybody is offering an HSA plan. I mean, you connect it with a high deductible bronze plan. HSA stands for Health Savings Accounts. Basically, they're 401k accounts for your healthcare plans, right? So an employee can put money away. You can put money away for the employee. It's pre-tax. And then when they take the money out, it doesn't get taxed, and they can use it for unreimbursed healthcare expenses. It's a big deal. And the beauty of the HSAs is that the employees can determine where it gets invested, and if they leave your company, the employee can then go and the money leaves with them. So the employees like that a lot because it's portable. It's a very, very good plan to offer and a great way to keep you ahead of your competition. Again, you can put company contributions, the employee can put contributions away in an HSA, and you have to connect it with a high deductible plan. You might want to also consider offering an HRA. It's a health reimbursement account. They were kind of a no-no under the Affordable Care Act. The Trump administration brought them back. The Biden administration is up in the air as to what they want to do with it. They may continue on, and I think that they will. You can offer this in addition to your existing healthcare plans. Now, the HRAs, they work like this. Say you don't have a healthcare plan. Say you're a very, very small business, but you want to offer some healthcare benefit to your employees. Well, you can put money away pre-tax into an HRA for your employees, meaning that they don't get taxed on it and you get a deduction. They can take that money out that hasn't been taxed and then use it to buy their own health insurance, even on the healthcare exchanges. So it's an opportunity for you to provide some type of a healthcare benefit without actually having a healthcare plan in your business. And even if you have a healthcare plan, you can offer an HRA in addition to your healthcare plan for just those employees that may or may not want to participate. So that's what I have to say. Those are some big tax moves you want to take when it comes to your healthcare. Let's talk about 401k plans. The Secure Act of 2019 gave us big incentives to start 401k plans. If you're a small business owner and you've got less than 100 employees, you can start a 401k plan at whatever cost that you have for startup, up to $5,000. The government will give you a tax credit for that. So whether you set up a single employer plan or a 401k plan, all of those qualify under the Secure Act, and you get a big tax credit for setting that up. So if you don't have a 401k plan, you absolutely should do it. It's not even that expensive to set up, but boy, it is something that every employer offers. And again, if you're looking for good employees this year, and you will be, it is very, very important to say that you are offering some type of retirement benefits. And here the government is basically saying, you set up a 401k plan, we will pay you to set up that 401k plan. Now, one other thing about that, the Secure Act, if you already have a 401k plan and you decide to start automatic enrollment, which means that all of your employees have to participate unless they opt out, if you do that, then you will get a tax credit of $500 a year for 3 years just by making your 401k plan automatic enrollment. So just bear in mind, these are some incentives for you to make sure that you get a 401k set up. And you really should have a 401k set up because let's face it, between the individual and the company, they can put away $58,000 in a year. Again, you can get that $500 credit for 3-year credit for setting up automatic enrollment in a 401k plan. Even if you don't, and you don't have a 401k plan, you should be setting up a personal IRA at least. You can put $6,000 away without paying any taxes on it from your income for a personal IRA. And if you have a very, very small business, maybe just you and 1 or 2 other employees, it's standard that people set up what's called a SEP IRA, a single employer pension plan. Again, $58,000 can be contributed to that as well, up to $290,000 of contribution. So those are all pre-tax plans. Don't avoid the after-tax plans that are available for you because they also have a lot of benefits. If you set up a Roth IRA for your employees, and you can do that on a corporate basis, then even if they've maxed out on what they're putting into their 401ks, they can put after-tax money into a Roth IRA, and whatever it grows over the years is tax-free as it grows. So that's a great, why not just have that plan set up and say to your employees, hey, listen, if you've maxed out on what you can contribute to your 401k, put it into our Roth IRA plan. And therefore, you can at least put money in the earnings on it, and the appreciation will be tax-free. Another big after-tax plan that has been very popular with my clients are called 529 plans. And on those plans, you can put after-tax contributions into those plans, and you can take it out without paying any taxes as long as you're paying for education expenses. And these education expenses are for like higher education, private school, even like religious schools as well. So 529 plans, to just get that set up, offer it to your employees. Say, listen, if you want, as a benefit we're providing to you, we've done the legwork, we've set up the 529 plan. You can take money, it's after tax, but you can put it away for your child's college in the future, and just know that it'll grow tax-free, and then you could take the money out tax-free as long as it was used for your kids' education, or for even for private school, middle school, high school, if they have to pay out of pocket for education expenses. So all of these types of plans, I call them retirement plans, are really, really tax beneficial. And these can all be offered by your company. And these are all benefits that you want to be providing to your employees to attract the best people there. Now, there's one final huge retirement plan option that I think that you should definitely know, and that is called a cash balance retirement plan. Now, this plan, I want to be clear what this is. First of all, the 401k plans are called defined contribution. So you just determine what you're going to contribute every year, and that's what it is. The cash balance retirement plan is a defined benefit plan. You determine in advance what the benefit is going to be in the future, and then you fund that every year. It's expensive, particularly if you have a lot of employees, because if you have employees, you're going to be telling them, we're going to provide these benefits to you in the future, and you will be obligated to fund the plan. So if you have, a couple of employees or more, I don't recommend this. But if it's just you in this business, or maybe you and a family member, you and a spouse, you and a partner or a sibling or whatever, this is a big deal, because you can set this plan up just for a couple of people. And listen to this, it's a defined benefit pension plan. You determine the credit in advance that you're going to credit to this account to pay for this benefit in the future. And get this, you can put away $200,000 a year if you're over 60 into this plan, and take a tax deduction for it. Now remember, with 401ks, actually this year it's $58,000 is the max that you can put away for retirement of 401k. With a cash balance retirement plan, you can put away $200,000 a year as a deduction. It goes into your retirement plan that you're funding for the future, and that you keep it non-taxable, and then you use it for, to pay it out in the future. A lot of people, when they get it, they buy like annuities with it. So, or they could just take the balance as a lump sum. So again, if you're approaching 60 or you're over 60 and you plan to be in business for still another 10 or 15 years, and you're in a business where it's just maybe you and a close family member, a spouse, somebody like that, talk to a benefits advisor or an accountant about a cash balance retirement plan. It could save you bucket loads on taxes. Now, there are some downsides to it, just so you know. You will have to make contributions that are generally higher than a 401k, because you are you're funding a benefit to be offered in the future. You're going to get annual actuarial analysis done, so you have to pay for that as well. You have to file a tax return. Of course, there are fees for all of these people, and then the investment managers, whoever are managing the money, they're going to charge their fees as well. So there are some downsides to it, but I'm telling you right now, this cash benefit retirement plan, big savings for a lot of businesses to consider, and something you should consider as well. Okay. The final bit on retirement plan has to do with this. It has to do with an employee stock ownership plan. Excuse me for a minute. And employee stock ownership plans have become much, much more popular over the past few years. And let me explain to you why. There has been a surge in business owners selling their businesses, and that surge is expected to even increase over the next few years. Why? Because there's a demographic of business owners right now that are getting older. A significant amount are over the baby boomers. They want to retire, they want to play golf, they want to whatever. This is a time to do it. Capital gains rates are still low, and they might be going up depending on what moves the Biden administration might take. Interest rates are very, very low, which is an incentive for people to borrow to buy out businesses. And inflation is still very, very low. So what do you do when you invest your money? You can put it into a bank account earning zero. You could put it in the stock market if you want that volatility, or you can buy, a business. And there is a growing number of younger buyers. There's millennials. Well, guess what? They're getting older. Many of them have been out and about in the field of work for 10 years or so, and they're looking to start up businesses and buy into businesses, and there's more of a demand to do that. So because of that, selling a business has become big. Now, if you're located in New York or San Francisco or Chicago or some hot urban area or whatever, Austin, good for you, okay? But as the great swath of business owners in this country, many of them are located in not as many sexy places. So maybe you're in a wonderful place in Missouri or Arkansas or Iowa. It's still tough to maybe attract a buyer for your business wherever you are. That's why ESOPs have become so much more popular, because if you have a hard time attracting a buyer for your company, hey, why not turn and sell it to the best buyer possible, your employees? So your employees themselves can buy your company. And what happens is that you set up this ESOP plan where the employees, where you get a loan from the bank, you put the money into a fund that's then used by the employees to buy shares in your company. The money that you're putting in there, whatever contribution you make, is fully deductible. Whatever the employees are then allowed to take in shares of the company, they don't get taxed on it at all. The banks provide the financing, so you're not using your own cash to give to the employees to buy shares of the company. You get paid out over time, so it doesn't happen once in a while, but you ultimately do get paid out what you're looking for. And ultimately, your employees become the owners of the company, and that is what better way to have great morale and great future of the company than have your employees have equity in the company. Now, these plans are expensive to set up and administer. If an employee departs, you do have a cash obligation to purchase the shares back from that employee, and you got to be careful with the banks, because sometimes some nefarious banks have gotten big valuations on a company so they can loan you more, because that's how they make their money, on the fees and the interest. So you got to be very careful about that. But an ESOP plan is a great tax advantage way to exit your business. And by doing that, you can really take advantage of selling your business and doing that over a few years of time. So I just want to make sure that you do consider it. Okay. So I'm going to wrap things up and we'll take some Q&A. But again, let me just take a few minutes out and recap what we've talked about. COVID, employee retention tax credit, partially shut down, fully shut down, lost 20% of your revenues in any quarter this year compared to 2019. You can get a giant tax credit, up to $7,000 per employee applied against your payroll taxes, and you can get the cash back if the credit is more. There is the Families First Coronavirus Response Act credit. If you're paying your employees to be at home because of COVID, you can get a tax credit to reimburse you for doing that, including vaccinations. The Work Opportunity Tax Credit. When you're hiring people to come back, you can get a credit of anywhere from $1,200 to $9,600 if they are long-term unemployed. The Charitable Contributions Deduction, up to 25% of your corporate taxable income can be a deduction. If you lost money in 2020, 2019, or 2018, you can carry those losses back 5 years, one-time ability to do that and get the money back in cash if you paid taxes in any of those 5 years. On your compensation, if you have a C Corp, pay yourself more, distribute less. If you have a pass-through like an S Corp, pay yourself less and distribute more. Hire your kids, pay them up to $12,000. They'll fully deduct it. You get a deduction for it as well. Nobody pays any taxes on that. If you're working from home and you're self-employed, don't forget the home office deduction. Your property, clean up your balance sheet this fall. Get rid of all old receivables and inventory, write it off, maximize your tax advantage there. Take advantage of Section 179. You can buy up to $1 million of equipment this year, take an immediate deduction. You don't even have to pay for it. Just get it financed. As long as you put it into service, you will get full deduction for doing that. And if you've got less than $1 million in revenues and 30 employees, less than 30, you can get a $5,000 tax credit for making your building disabled access. Paying your employees. Help them with dependent care. The IRS will give you a big deduction that you can take for dependent care. Offer a better PTO plan, meaning that if people take time off for family and medical leave, if you pay 50% of their compensation, you'll get a tax credit of 12.5% to 25%. The government will give you money back for paying people to take time off. Pay for their education up to $5,250. If you do that per employee, you get the deduction, they don't get taxed on it. It's a great incentive that you can be offering. And people looking for adoption, that's more than $13,000 is that deduction. You don't have to do the whole thing, but it's a great benefit that you can offer to your employees, makes you look really good. Few will take you up on it, and even those that do, I think it'll be well worth it. Offer a health savings account and or a health reimbursement account. Health savings accounts, those are the 401ks for your health care. People put money away pre-tax. They take the money out. They spend it on whatever they want. HRAs, people put money in pre-tax. You can put the money in. They take it out. They buy their health insurance elsewhere. Max out your retirement contributions, not just for pre-tax plans, but even after-tax plans like Roth IRAs and 529 plans as well. Max them all out. Push those tax liabilities out into the future. Start a 401k plan this year. You get big benefits under the Secure Act, or even if you have a 401k, make it automatic enrollment in it, and you will get a $500 a year tax credit for doing that. Start a 529 plan I mentioned, or consider an ESOP as well. If you're selling your business, it is a great tax advantage way to sell your business and get your employees involved in your business so you can get an exit out and play some golf. Okay, so Angelo, I think if we have any questions, first of all, that is my email address, guys. So if you have any questions whatsoever, feel free to email me directly. If you'd like a copy of this PDF, even if you're watching this after the fact, feel free to send me an email. And I can send you a copy of this PDF because there's a lot of information in it. But if you want to email specific questions, that's also okay as well. So Angelo, if you are still there, I'm more than happy to answer questions now, or we can take them later.
Yeah, great. And so if you want to ask a question, put your question in the Q&A section or the chat room. We've got a couple of questions here right now. Can I get a PPP loan and use the employee retention tax credit?
So the answer is yes, you can. So if you have a PPP loan, or even if you go for a second round, and by the way, those loans expire, the deadline is March 31st right now. Might be extended, but right now it's not. But if you get a PPP loan, you can still get the employee retention tax credit. The thing you have to be aware of is that you can't use the same compensation you're using for forgiveness on the loan and then use that same compensation to calculate your employee retention tax credit. So you got to use one or the other. There's no double dipping.
Another one, I heard the taxes will be increasing for S Corps. Is that true?
So right now, the Biden administration supports, there is right now a pass-through, reduced pass-through savings for companies that have S Corps and limited liability companies, which means that if you have an S Corp, you get to knock off 20% of your revenues before your taxes are calculated, which is a big incentive. And that was from the 2017 Tax Reform Act. Well, that is the case right now, but the Biden administration is considering in the future for people making more than $400,000 a year, phasing out that tax benefit that pass-throughs get. So if you're in that range, you could be looking at paying more taxes. Now that hasn't happened yet, but it is something that's being considered in the future.
Last one here. Whatever happened to association health plans?
So association health plans were an idea from the Trump administration where people could join together as an association. They could be geographically located or in the same industry, form their own health plan, and then by doing that, they can negotiate lower lower rates for that for their health insurance. Unfortunately, that was all done by executive order, and they was being contested in the courts. A lot of people weren't doing it because of some of the controversy around it. And then it was part of the first round of executive orders by the Biden administration. The association health plans have pretty much been overturned. So not an option going forward for your health care, I am afraid.
Okay, that's it. I guess, Gene, thank you so much for a great presentation.
Sure.
Very valuable takeaways, and we appreciate you taking the time to do that. I just want to remind everyone who's on the call that we will host another webinar Tuesday, March the 30th at 11 a.m. on the McKay Group Financial Benchmarking Survey. Your company should participate in this valuable survey that offers more tools for success for your organization. So until next time, stay safe and healthy, and have a great day.
See you, everybody.
Thank you.